What's up, guys? Welcome back to my personal finance channel. I hope you guys have been enjoying the videos. If you have, please give them a thumbs up and subscribe to the channel. It really helps me out, helps out with the YouTube algorithm. And yeah, lets me know you guys are appreciating these vlogs. But today we're going to be talking about call options, more specifically selling call options. Yeah, I really only trade these one way, and that's what I'm going to cover today. The other way is similar to shorting a stock, which most of you probably aren't going to have the ability to do in your options account. And it sort of leaves you vulnerable to unlimited upside risk. So because of that, I am only going to cover this one method, and I hope that makes sense. I guess when I start getting into it, maybe it will make more sense, because one way is basically selling naked call options, meaning you don't have the underlying stock to cover that position. Say it moves, higher. The other way is basically having the stock to cover that position if the stock moves higher. So let's just jump right into it, and I think it'll make a little bit more sense. But selling call options, let's go. Okay, so selling call options. I don't do it all that often, but every now and then, such as in this current market, I've done it on occasion. Basically what it is let's just break it down by when you buy a call option, it's giving you the right to purchase the underlying stock at a given strike price. Therefore, the person who takes the other side of that trade, the seller of that same call option, is basically saying, I'm going to sell those shares of the underlying stock to you at the given strike price. So if you think about it, if you sell a call option at a certain strike price, let's just say we have a stock like NIO trading around, let's just say it's trading at $50 because it's a nice round number and I like round numbers. Let's say we have a stock trading at $50. Well, I own 100 shares of NIO. So what I can do is, if I think that NIO is going to stay flat or potentially go down because the price has gone up so much in the past couple of months, what I might do is say, well, just holding NIO, they don't pay a dividend. I'm not generating any extra money on this, and I don't think they're going to go any higher. So I'm going to sell a call option. And by doing this, I can generate extra income, right? It's kind of like making your own dividend on a stock that doesn't pay a dividend otherwise. But what it's also saying is, by selling that call option, you're saying, I'm willing to sell this stock, 100 shares per contract that you sell, at the strike price by the expiration of whatever expiration date you choose. So back to NIO stock. If it's trading around $50 a share, I might say, well, I'd be willing to sell the $53 strike call options. And let's say I find an expiration date where those call options are trading at $1. So what that means is I can sell that call option for $1 or $100, because you have to multiply that price by 100, representative of 100 shares of the underlying stock, meaning I collect $100. As the seller, I collect that $100 premium. Someone else is buying that call option, so they pay the $100 premium. That gives them the right to buy the stock at $53 a share, but I have to sell it at $53 a share. So by owning the underlying asset, my risk is basically, I'm saying that, say the stock jumps to $60 tomorrow. Well, now this call option is going to be in the money. The person who bought it can say, hey, I want to exercise my call option. I want to buy the shares for $53. So instead of me selling the stock at $60 a share, I have to sell it at $53 a share. So I still made $50 up to $53, but instead of making the full 20% gain that the stock encountered the next day by trading up to $60, I collected $100 in premium. I can sell the stock at $53, and no harm, no foul. I'm basically just capping my upside. But the benefit is, say the stock just stays at $53. Well, I made $100 extra over that 1 month, 2 month, 3 month period, however long the expiration date is, right? Where I have my 100 shares as collateral. So by selling that call option, I was able to generate an extra $100. Whereas if I didn't sell that call option, I would have gotten no return on the stock just sitting at $50, sitting at the $50 a share price for the next 1, 2, 3, 4 months. Also, if the stock traded down, that call option would just slowly go to zero, and I would just collect $100 premium still, right? So meanwhile, I lost some value from the stock going down, but I still got $100 from selling that call option. So that's sometimes what I'll use. If the stock trades higher, you've capped your upside, hey, the most I'm gonna get is selling it for that strike price, but I still also get the premium. So in reality, you sold the stock for around $54 per share if you add that $1 to the 53 strike. But you're basically, the idea of selling this is that you think the stock is either going to go down or stay flat between now and whenever that option expires, and you want to collect a little bit extra premium. So it's a way to get a little bit more juice out of some positions that you might have that have performed really well, and you think they're not going to go much higher, or maybe they're going to sell off. You're able to collect some extra premium without actually selling out of your position and doing something else with that money. So that's kind of how I use call options on the selling side. I don't do it all that often, but every now and then I'll find something, or there'll be a nice juicy premium that I can sell a call option for, and collect $200, $300, $400 on a position, and just able to pocket that extra money. So that's how I look at it. If you think about it the other way, naked selling call options, it's when you don't hold the underlying, which means that if NIO shot up to $60 a share or $70 a share, and the buyer of that call option said, well, I want to buy the shares at 53. If you don't own those shares, that means you have to go out into the public market, buy NIO at $60 or $70, and then sell it to somebody else for the $53 strike price. So you're kind of opening up a bag of worms there, a can of worms, whatever the saying is, where you have unlimited upside risk. Because say NIO goes to $100 a share, maybe someone buys them out. What if Tesla buys NIO for $100 a share, $150 a share? Well, you have to go and buy the stock on the open market because you don't own it. So if you have to buy it for $100 a share and then sell it to somebody for $53, you basically just lost half of that money, right? Half of 100 shares times whatever price it's trading at, and then subtract the difference between $53 a share. You're losing a lot of money on that trade because you don't own the underlying. So I really only do this if I own the underlying, and I don't think I even have the ability in my account to do it without it. But that's how I trade options or call options when I'm on the sell side of it. If you haven't seen it already, I do have another video for buying call options and sort of my strategy and thought process there, so be sure to check that out. If you enjoyed this video, please give it a thumbs up. Subscribe to the channel, it would really help me out, really appreciate it. And if you have any questions, leave them in the comments below, and I'll try to make another video or just address them in the comments. But that's gonna be it for this video. Hope you enjoyed it, and until next time, thanks for watching.